I've included a cover letter that I like to include with offers that, or my approval letter that goes over to the listing agent. And I can cater this and change it in any way that people see needs, but I think it's a good added, we're always looking for that unique tool. I always tell agents the agents that I work with, that when they're presenting an offer, have me call the listing agent. It's super impactful. And for a while there, it almost became more cliche-ish and too common practice, but I don't think people do it that much anymore. I think when the listing agent gets a phone call from the lender, specifically right after, and many times I call before they've even received the offer or before they've even read it, and it's impactful. I know that most listing agents make good comments about it. They're very well receiving of the phone call, and if you're one of three offers and I'm the only lender that's called the listing agent, it's going to resonate in their mind, because we all know it's not always the highest offer, it's not always the best. Servicing such a cluster sometimes, especially when clients, the reality of it is when the client gets their closing papers, there is a form in the paper that says where their first payment is supposed to go, but still they call me and they're confused about it. So we've created some new easy, or we call it smart lending is one of the terms that we use for it. But Fairway Next is a new program that we've created that clients can actually look up where their payment is to go. And not that I don't want them to call me, I definitely want them to, but it's just good that people are more comfortable with the servicing of their loan, because most loans right out of the box are sold to a secondary servicer. And that's, sometimes I have clients call me and they ask, where's my loan going to be serviced, or do you keep my loan? Well, the reality of it is nobody keeps the loans. Even the Wells Fargos of the world, we can't be in the business of warehousing loans if we're going to lend money to the next group of people. So they all get sold to Fannie Mae and Freddie Mac. And it's not a big thing, but it's good for you guys to know that, because when the customer comes to you and says, hey, I heard my loan's going to get sold to Fannie Mae and Freddie Mac, it's good for you guys to be comfortable with just the fact that, yeah, all loans get sold to Fannie Mae and Freddie Mac. It's not a bad thing. It's just who you're going to make your next payment to is going to be the servicer of the loan. It's not going to be the lender that you close your loan with. And we're working hard on our servicing. Actually, currently, we've closed $31 billion this year to date as a company. Top 5 company in the country when it comes to volume, etc. And so we are all about making sure that our servicing is on the ball, because there are experiences. I've had customers come to me that want to refinance just because of their servicing. They're like, I don't like this company that's servicing me. And I'm like, well, it's going to be tough, because there's only about half a dozen servicers out there in this market. So it's hard for me to guarantee you where your loan's going to end up. But we also have an option where we can guarantee a customer with a small cost that we will keep their loan and we will maintain the servicing of their loan. So we have options like that. So as far as programs, and give me some ideas of what you guys want to know about. I don't want to go too elementary, but at the same time, I could start on a topic that you guys are all well informed on already, and the low down options that we've had, they've started to come back in the market. Low down meaning, the 3%, 5% FHA, all that has always been here, but there were some times, maybe 6-7 years ago, actually about 2008, which was 11 years ago, but when the market took a crash, lenders took a lot of these low down payment loans out of the market, or made them not as easily available as they have become again. So we're back in a market where pretty much all low and no down payment loans are available. I will tell you, make sure that you're aware that if one lender says I can do something and the other lenders aren't telling you they can do that, there are no secrets out there in our market. We all get our money from the same place. So nobody has a unique program that other people don't offer. So be a little leery of that. If your customer's hearing something from somebody that says, oh, this guy says he can offer this, and your lender of choice, or if it's me, if I tell you I can't do it, there's high probability that it can't be done. We do have a direct connection with a product desk that operates for our company. And so I'm not just saying this is stuff that I don't know about. I run it past my product team. And if we don't have it, there's a high probability that it can't be done that way. So I don't know there are definitely some unique, and I hate to see it, but there's subprime markets coming back in a little bit. Subprime meaning Alt-A, people that don't have, low credit scores, no income verification, that kind of stuff is starting to creep back in the market. And I'm not a big fan of it personally, but there are needs for it. And we do have certain individuals out there in the market, or you will come across certain individuals that have a large down payment and they don't have great credit, or have a large down payment and they don't have great job stability, all that kind of stuff. So, but I always tell people that a loan is kind of like a tripod. The characteristics of a loan are a tripod: the income, the employment, and the assets. So if one of those legs is weak, the other two can make up for that. So if you have weaker income and you have a large down payment, sometimes that can be offset. So tell me, anybody have any questions about like specific programs that they are not quite clear on?
Well, some of us are total newbies. I
Right.
mean, like half the people in this room are
Mhm.
completely new.
Right.
So if you could just kind of go over what the options are.
So let's start with zero down. The best, by far, zero down loan out there is VA, as we probably all know. VA is, even if you have a down payment, a VA loan is the best possible loan that a buyer can get. And I say that because you can buy, in fact, VA, I'm not sure how it's going to look yet, but VA has announced that they will be removing the ceiling for VA loans, and I'm not quite sure how that's going to look yet, because they haven't released the official letter that describes how it's going to look and how we're going to implement that how lenders are going to implement that in general. But it used to be where VA had a ceiling of 725, which was the maximum for conforming high balance loans. So now VA is going to take that ceiling off, and once again, I'm not sure how it's going to look, but what they have done in the past, and a lot of people don't know this, that you can go up to $1 million on a VA loan. In fact, I think you can exceed that, but I believe it was just $1 million this last change. So, how you go to $1 million on a house is $725,000 is your maximum, and then you take that difference between $725,000 and let's say $1 million. Let's just say for round numbers, $300,000. The buyer has to put down 25% of that difference. So if it's 25% of $300,000, that's $75,000 that they have to put down on the house. And so you're putting $75,000 down on $1 million house, and you're not paying mortgage insurance. So people with people with VA eligibility don't necessarily know that. Not every person with VA eligibility can buy $1 million house, so it may be a moot point for most people, but it's a nice little thing that is nice to know as agents. So if your customer happens to say, "Oh, I was in the military," let's talk about your VA status. And as soon as you talk to Thomas, make sure you mention to him that you were in the military, because I actually had one customer one time that came to my office. We talked about loans. He never mentioned to me that he was a veteran. I didn't pick up on it that he was a veteran or even ask him. And he walked away and ended up going somewhere else and using his VA. And I was like, I didn't know you had VA, but it was on me to ask. So anyway, it's very important. In fact, if I were you as agents and you come across buyers, I would ask every one of your buyers, they've ever been in the military, because it's really a very, very, there is no better loan. There's no better loan. Zero down, full.
What is the rate on that now?
All VAs are in the 3s. So it's a very, very competitive interest rate. The key to the VA is no mortgage insurance. So if you're comparing apples to apples, a VA versus an FHA, VAs have no mortgage insurance, whereas FHA has a mortgage insurance premium of 1.75%. And then their mortgage insurance is based off the loan balance, and it's 0.85%. So let's just say it's about 80% of their loan amount, or not 80%, but 0.8%. But it equates out to, let's say, like on a $400,000 purchase price, mortgage insurance on a $400,000 house is in the 3s, $300 and something a month on an FHA, whereas a VA, so comparison, an apples to apples comparison, VA is going to be about $300 to $400 cheaper than an FHA in a monthly payment. Now VA does have a funding fee that offsets the fact that it doesn't have mortgage insurance, but the funding fee is financed into the loan, and it still, in the big picture, makes pencils out to be a better option. So VA, by far, best loan out there. Other zero down options are USDA, and USDA is a geographically dictated loan, where meaning that east side of Highway 9 kind of is the general area. So going, south to north, east side of Highway 9, Lake Stevens, Granite Falls, that kind of area. So if you have a customer that doesn't have another option for a zero down and you want to find them a USDA, a lot of sellers that know that they're in a USDA zone will put that on their listing, as you guys probably had listings out in that area that you put it on your listing that USDA is an option for this. Another great loan. USDA is a fantastic loan. I think even in an apples to apples comparison with FHA, USDA probably beats FHA.
But then is there mortgage insurance with
There
that?
is, yeah. For mortgage insurance it's either 0.3 or 0.4%. So it's about half of what FHA says. And it also has a funding fee with USDA. But it allows for zero down. And USDA does have some income limitations, so that's also an impact. So income and geographic limitations. And then FHA the other zero down option is state bond money. And we use that. We have that option here with Fairway. We've made a choice to offer those loans. And I say we've made a choice because a lot of lenders have chosen to just discontinue USDA, or not USDA, but down payment assistance, or it's Washington State Housing and Finance Commission, WSHFC, as an option for lending. A lot of lenders have just chosen not to do those loans. And primarily, we write a check when we do those loans as a company. We don't make any money on doing those loans. After we get the loan closed, and the loan officer gets paid, the office or the company itself doesn't make any money on those loans. So a lot of companies have made a conscious decision not to offer them for that reason. We don't do a ton of them, and I find those loans to be a great option to at least get the customer in the discussion of buying, and then a lot of times they find that, oh, maybe that's not the best loan for me, because it's not. The Washington State Housing and Finance Down Payment Assistance Loan is not the best option in comparison to other loan programs. It's a last resort if somebody literally does not have any money to put down and they have no way of coming up with money. When I do meet with customers and talk to them about that, I'll show them the comparison of the two, and the Washington State Housing and Finance is not the cheapest option. It's not going to keep their payment as low as even an FHA loan, because Washington State Housing and Finance is offered for FHA and conventional buyers. But it is a viable zero down option if somebody comes to you and just says, I don't have any money to put down. Washington State Housing and Finance is a good option for those types of buyers. And then FHA is kind of the catch-all for, FHA is probably most commonly used for credit or poor credit. If somebody doesn't have the best credit, then we will look to an FHA loan. We can also stretch debt to income ratios on an FHA loan. So FHA allows for a little more leniency on how much a person can borrow or how much a person can buy. And I always go through the process with a client from the beginning of, I want to know, we want to talk about how much you can buy, but I also want to know how much you want to buy. Because I think too many people force themselves into houses that they can't afford. And often I've told people that you can buy more than you're going to want to buy. So let's be careful with this, because I don't want you to feel like I'm pushing you, and I know your agent doesn't want you to feel like you're being pushed into a house that you can't afford, or that you can afford from our standards, but by the time you get down to your budget, you go, ooh, that's more than I want to pay. So, and those are good customers to have. I like the conservative approach, and I like customers that aren't trying to overbuy. And so anyway, there's different theories on that, but I think that we all agree that we probably don't want to shove people into houses that they're not going to be happy with, and they're going to want to turn around and sell in a short period of time because they can't afford them. But FHA does allow for less than perfect credit, and the reason we would turn to an FHA for less than perfect credit is because conventional loans, even though they allow a lower down payment option, the mortgage insurance is really ugly when it comes to like mid to low 600 credit scores, the mortgage insurance is super, super expensive, to a point of where they're saying because it's insurance. Mortgage insurance is insuring against loss. And if the person has less than perfect credit or really poor credit, then they're going to be a high risk. So the mortgage insurance is expensive for.
Can I interrupt you for just 1 second?
Yeah.
So you're saying that if they are a poor credit risk, that there is a higher premium on the mortgage insurance?
Oh, yeah. Yeah, mortgage insurance is graded heavily based on, and to the detriment of the low credit score person, it really benefits the high credit score person.
Okay.
So I remember, I've been in this business about 25 years, going on 26 years. And I remember early on days where mortgage insurance was like a swear word. You talk to people about mortgage insurance and they're just like, oh my gosh, I can't have mortgage insurance. My parents would just be so upset.
Wanted to have a first-time homebuyer class, and target market people that live in apartments and so forth, and offer this class, first-time homebuyer. I like to tend to reach out to investors, people that may want to buy a vacation property or a second rental home or different things like that. And I do get a lot of people that see me, and because we do that, that's they want to know, well, hey, how do you if I were to get this other property and so forth. And you and I are a good team to talk about that, but. So between first-time home buyers, the investor classes, I was going to ask about bridge loans for seniors.
We actually are coming out with a bridge loan product currently that we are,
can you explain what a bridge loan is?
Bridge loan is loaning a person money against the equity of their home that they currently live in to give them the ability to buy their next house. Most bridge loans require still that you be at 80% loan to value. So let's say their current house is worth $400,000 and they owe $300,000 on it. Well, then you really only have a small amount of money that you're going to be able to bridge or borrow to buy the next house. So bridge loans are they're tough, and most bridge loans, in fact all bridge loans, the purpose of the bridge loan is to enable the client to buy, but they want you to use them for the purchase as well. So we're not going to do a bridge loan for somebody and say, okay, now that you've got your bridge loan, go down to this bank over here and buy your house. No, if we're going to do the bridge loan for you, we want to. And it's a product that probably does. I think I'm sure the percentages are low, but I know that bridge loans don't get used that often. People get set up for them in the necessity for them if they need them, but they don't. They're very rarely used, and that's just because people find a house and they put their house in the market and it sells so quick that they really don't need to use the bridge loan, which is fine. It's great because all the bridge loan really is, it's not a profit center for us. It's a tool to help the customer to get to that stage.
So I heard from another lender is that the same thing as cross collateralization?
There are some banks or I think Charles Schwab is one of them that does cross collateralization loans.
I was at Absolute Mortgage.
Okay, maybe they may have a.
What's the difference then?
I'm not sure what a cross collateralization. It would sound like the sounds of that make it sound like it would be a similar type
I think it is
product.
similar. You were at that, right?
Yeah, I'm not positive what that is. And there aren't a ton of opportunities for bridge loans, but it's nice to be able to say that we have one, and I know that we've got one coming out. I'm not sure when it's going to be released yet, but I know.
The reason I ask is I know there are other companies that offer a concierge program and offer bridge loans, and these are all great tools that agents can use to open up the eyes of buyers that might not have known that this is a possibility. They want to buy a house, they're short on funds for the down payment, can they get a bridge loan to get this new house so they can get out of this one, get it fixed up,
right.
And then sell it and get it on the market, so if they can get a bridge loan to get this other one first.
Right. The biggest challenge with that is also people being able to qualify for both houses, because even though we get a bridge loan on your house, we still can't discredit the fact that you have a mortgage that you have to pay for, and we have to count that in your overall debt-to-income ratio. And that's part of the reason why bridge loans are few and far between, because not very many people can qualify for both houses. So we do have some products that I believe they are in our, we have a couple of specific investors that will allow for a client to buy the next house, and we don't, if they have their current house listed, we don't have to count their payment on that house, but that's on a specific, individual basis if they qualify for that.
Well, I think that's similar to the cross-collateralization, because I think the way that it was working, because it was a cool product, because what you could do then is if you had fairly high equity in your on your first mortgage, right?
Sure.
So you don't owe, it's
Oh, very little.
yeah, but then you could do this type of loan that you're not contingent on your second
Okay.
your offer.
Okay.
So you're not, right? So then the cross-collateralization then gave them, I think, around 9 months to sell that first house. So
Right.
you're not in a panic.
Yeah,
So
that's-
you could, it gives, so it allows people like that, first of all, that freedom to think, well, I can go do something
Right.
and not have to worry
Exactly.
that I have to sell my house in 45 days.
Right.
Right? So
Yeah, that's-
it was a good product, but I can't remember all the details.
Yeah, we do have an option for that if somebody wants to buy the next house before selling their current house.
Do you
Yeah.
have anything in writing, like a flyer or a link? Or
I could send it all to you.
Some kind of a visual that we can add into some kind of marketing?
Sure,
That would be
absolutely.
fun.
Yeah, I can offer that, or I can get something for you guys. And send it to
And
you.
then talking about different niches, what you're going after, like, and then I think another thing, like, if you have something that's like for first-time home buyers, that shows the difference, like, if you are paying $2,000 a month rent, what could you afford to buy? Because what you're saying...
What your rent equates to.
Yeah, because what you're saying is people think they have to have all this money to get out of that apartment.
Exactly.
Where they really don't. And I think that young, well, and they're not so young anymore. People are sitting in these rentals forever.
Oh, yeah.
Because they can't save,
Fear.
because their rent is so expensive.
Mhm.
So if we had a way to tell people who are renting, I mean, I had a client call and she goes, oh, can you find me a rental for $2,600 a month? I'm like, and why aren't you buying a house?
Right.
Right?
Yeah.
So, but, I mean, she had a reason that they wanted to get to know the area a little bit more. But if you add it up, what they're going to lose in a year's rent at $2,600 a month, that's a lot of money to
Yeah,
give to
absolutely.
somebody else.
Yeah, $2,600 a month is about a $460,000 house with an FHA minimum down.
Right. I mean, even if they stayed in the house for a year or 2 years,
Right.
where would they be, right?
Exactly.
So do you think that you would have enough content to, I'm sure, first-time home buyers is not a problem, but VA informational class to put it out to VA people for an hour, or, senior downsizers, do you think that you could put enough content together to
Sure.
be able to do some kind of a class?
Sure. Yeah, if I knew specific interests, since, like I said today, I don't want to go too elementary, but at the same time, I want to answer what you guys want to know as opposed to what I want to share with you. So, but yeah, if I knew the content that needed to be delivered,
I
absolutely.
mean, because my wheels are spinning, I'm just thinking, Granite Falls, just think, okay, if I could hold some kind of a clock hour class up in Granite Falls and say, hey, did you know you can get a zero down loan if you purchase in this geographical area? If you'd like to find out more information, come to this free meeting for an hour, so just kind of
Right.
offering that, having you do a pitch, and, if it's just something that takes 15 minutes and then you're done talking, it's
Right.
like, could there be enough to drag it out to, an hour-long clock hour class,
Yeah.
or not clock hour, but a informational class?
Yeah, I like the idea for even like a first-time home buyer.
Mhm.
I just recently talking with my son, and we were talking about buying a house, and his girlfriend's mother said, well, you guys can't buy a house. You need at least like $80,000 down. And I'm like,
Yeah.
no, you don't. So there's an
Don't.
education
Yeah.
process
They don't know.
there that you're right. You're absolutely right that people just don't know. There's this myth out there that you need so
Absolutely.
much money, and then when the kids are told that, they're like, oh, I don't have enough money in the bank, and
That's
then
my
they
mom said.
yeah,
Right.
and so yeah. So anyway,
And I still think VA is the most untapped, even though everybody talks about it,
Right.
I still think it's the most untapped market out there. The veterans, I have had customers in the past that, and what you need to know about veterans is a lot of veterans, parents were veterans. So they grew up as veteran kids. And when my grandfather was in the military, they moved all the time. My mom probably lived in 5 different places. And they just didn't have that security. So when you're a child of a veteran, you get kind of scared to buy something because you're thinking, well, we're going to move tomorrow. So I think that a lot of veterans are afraid of buying because they don't know what they don't know. And I just say that's one of the most untapped areas because it's so easy as a veteran to buy a house.
Yeah.
If you, like you said, you talk to a person with $2,600 a month for rent. If they were a veteran and they have even okay credit, that's the other great thing about VA. You don't have to have good credit at all. But even if
Down to 600, well,
600.
600?
Mm-hmm. Yeah. VA is so there's just so many parts of if you meet a veteran and you don't talk to them about buying a house, you're missing a huge opportunity.
Yeah, wow.
And not just for your benefit, but for their benefit. Because veterans, I had a customer, tell the story all the time. I had a customer quite a few years ago, but they were paying $1,000 a long time ago. They're paying $1,000 a month for rent.
Wow.
So it was a long time ago. They lived in Marysville. But she was a veteran, and she, once again, parents were veterans, so she moved all the time. I said, you guys have been living in this place for 10 years. I said, and I did the math for them, simple math back then, $120,000 you've given your landlord over the last 10 years towards his or her future. And they're like, wow, I never really thought about that. I'm like, yeah. And you're a veteran. You have to put 0 down, and you can buy a house, and they did. But it was just, there's so many veterans out there that need to have their eyes open to this kind of stuff because it's a very, I still think it's an under-tapped market.
Yeah.
Especially in this area. We have so many
Your
veterans
point
now.
too, Daniel, how long is it going to take them to save $80,000?
Absolutely.
Right
Now,
Yeah. Have $80,000 in equity.
Who does that? Yeah.
Yeah.
Very few people have the ability to save that kind
So
of money.
what about the, 5 and 7 year loans? Are there?
Oh, yeah, those are great. Yeah, those are actually,
Everybody we kind of got afraid of them. So as an agent, how would you address that kind of making clients be open to using these shorter term loans? I mean, how many of these young people stay in their house more than 7 years?
standard time in a house is 5 to 7 years.
However, it's a higher payment, is it not?
No, an ARM is actually a lower interest rate, so it's a lower payment. It does require a higher down payment. So,
okay.
so the adjustable rate mortgages, and they're typically 5 or 7 year adjustable rates. Used to be more broad spectrum of them, but and true story, up until 2016, I had never, and we've been buying real estate for 20 years, 25 years, and I've never had a fixed rate up until about 3 years ago.
Wow.
And that was just because rates were so low in 2016. I decided to get into a 30-year fix. But I've just never had a 30-year fix. I always chose ARMs because there was enough of a spread between a 30-year fix and an ARM to make it worth taking that ARM. And most people that understand or that are interested in adjustable rates, most of them have higher balance loans because it makes more sense. If it's a 1% savings in an interest rate and it's a $1 million house, that's $10,000 a year in interest that you're saving, roughly $10,000 a year in interest that you're saving. And you do that over 7 years, that's $70,000 that you're not paying in interest that you would otherwise be paying on a 30-year fix. And like you said, most people, they're either in a home or a loan less, or 5 years or less, because all sorts of things happen. Divorce, kids going to college, all sorts of other reasons why you may be tapping into the equity of your home. I can't tell you how many people call me and say, okay, we're going to get this loan, we're going to do a 15-year fixed, and I'm like, why? Because you're not going to be in that loan for 15 years or even, more than 5 to 7 years. And people don't understand that, they dispute it or whatever, but that's statistics. It's not just me guessing or thinking that way.
Well, it's looking at the situation. Every situation is different.
Absolutely.
Right?
Yeah, there are certain
and
people.
There's a lot of people out there, you're right, that we all, I think, conservatively go, oh, I need a 30-year fix because, that's what we've all kind of been taught. I mean,
Right.
that's what I was taught when I first started buying.
Right.
Because I don't want my interest to go
Right,
through
exactly.
the roof.
Over the last 2 or 3 years with rates dipping into the threes a
Right.
couple of times in the last 3 years.
Yeah.
It's been a great opportunity to take
Yeah.
advantage of a 30-year fix.
Sure.
And depending upon the market and the spread between the ARMs and the 30-year fix, sometimes it's not enough of a spread.
Right.
And a lot of lenders don't, we only have one real great option for ARMs within our investors, and a lot of lenders don't have a lot of ARM options, so they're not really a viable, they're not a great option for buyers. But like I said, they do require a higher down payment, so they're probably more of a high equity, somebody that has maybe 20 to 30% down is going to get the best option on an ARM. In fact, I've got a couple of refinances that I'm doing for people right now that are getting 3% on an ARM, but they have 70% or lower loan in relation to value in their house. So, but ARMs are a great option.
Might be a great class to have too, just about that move you're talking about for the 5-7 year client that's
Right.
been in their house that long.
Right.
Let's now teach them how to keep that first house and buy
Exactly.
and leverage that, build wealth, and buy the next.
Exactly. And then you're turning it more into a wealth building, conversation.
Yeah, no longer.
Longer term, absolutely, 100%. Yeah, I will tell you though, I always caution real estate agents, just like when your customer calls me and wants to talk about towns or cities to buy in, I don't even go there, because I don't want to detour them. I mean, you might have been showing them Marysville for the last 6 months, and they come to me and I go, oh yeah, Everett's pretty cool too. And they're like, why are you talking to my customer about that? Like, we don't, you don't even know the conversations that I've had with them about why we're shopping in the areas we are. So I highly recommend real estate agents stay, even though you know enough to be dangerous, I highly recommend you stay out of the conversation of financing in general. Just, not that you don't want to talk to them at all about it, but just, you want to sound intelligent on your end to at least say, I know these little things, but I just wouldn't go deep on a financial conversation with customers, just because it's hard enough to keep up with, when I live this business, it's hard enough for me to keep up with the knowledge.
Concept on our
Oh, absolutely, yeah. But I just know some agents really want to get deep on the financing, and really just let me do my job. And a lot of agents are like, I don't even want to know anything about it. Just you just do your thing, and I'll send them to you and teach
And I
you.
think if you have referral people that you know personally,
Mhm.
they don't want to tell you their business.
Right.
And so you say,
You're
look,
right.
you talk to the lender, there's no problem.
Right.
I don't really know what you make, and I get a letter.
Some of them don't want to
Because some
want
of
you
your
to know
friends
anything about their
won't
personal
ask
finance.
you.
You're right.
They
That's a
don't
good
want
point.
you to know
Especially if
their
they're your friends.
finance.
Right.
So you need to let them know that, and I'm like, hey, that's a whole different, just give me a letter, I don't know what you make it, because they don't know that, they think that you know everything about
Right.
it. And some people are really personal.
You're right.
And your friends are like,
Very
you
true.
want them to know. So you could lose your friends if
After
family.
patient confidentiality.
I always make sure every client, especially if they're like a friend of yours,
Yeah.
and they come talk to me,
Yeah.
just so you know, Sherry and I don't talk about your personal
That's right.
finances.
It's important.
I know you guys
You
are
don't do that.
good friends and
Well, you
and same
wouldn't
thing with my
practice
friends when
law.
they come to me and do loans with me. I'm like, just so you know, our friends don't know anything,
That's
and
right.
definitely a hands-off topic for sure.
Do you guys do reverse mortgages?
We do. Yeah, reverse mortgages are very, as far as like some of you were saying, it's a financial tool. And it's a great option for people that are over 62 years old and want to stay in their house. A fantastic option. That could be another, 2-hour conversation is about how those benefit people. But a lot of people don't understand reverse mortgages. Well, I would say nobody understands reverse mortgages, especially the ones that are, I would never do a reverse mortgage ever in my entire life. And I was one of those people before. But I do know that they are a great option. You can actually use reverse mortgages for purchasing homes too. So they're a great tool to be used for the right person. Specifically people that want to stay in their house for a long time. They have good health and they're like, I'd like to stay here, but I'd like not to have a house payment. And the biggest fight on that is, I want to leave something for my kids. Well, why? Your kids don't need your equity in your home when you're done. It would be better for you to use it right now and live a more comfortable life. And I think if we had a conversation with your kids, they'd say the same thing. So
How much equity do they need to have in the house to get a reverse mortgage?
there is a calculation, and I wouldn't say there's a general amount, but usually for somebody that has a house already, it's about 50%. And then, but we calculate, there's a calculation based on their age and how much equity is in their home and that. So I wouldn't be able to give you a generic answer for all people, but I just find out the person's information and I send it to our reverse mortgage team. We have a reverse mortgage team that just takes care of all that. So I don't personally process the reverse mortgages, but we're good at it. We're very.
Are there some instances where I've heard that you get paid for a reverse
Usually.
mortgage? Do you always get paid, or
No.
just in some instances?
Not some instances. Yeah, if they're younger and they have X amount of equity in their home, they may only qualify to not have a house payment. But you can also get what's called a line of credit on a reverse mortgage that grows over time, and you can use it and pay it back and keep it open, and it grows. I think it's 4% per year that line of credit grows. So that's another great tool that people use. Like I said, we could get into, and I can let you guys know when we're having reverse mortgage, people come in and talk. We have a gentleman that works out of our Wisconsin office that comes quite often to do presentations, and I can let you guys know when that is if you're all
Okay,
interested
yeah,
in more
that'd be
about it,
great.
because it's a great, phenomenal loan product for people. Not everybody, but some people are so that they would never even want to talk about it. So.
Well, it's kind of a scary word for some people.
It is, yeah, and part of it is just there's so many companies out there that have grown up on taking advantage of people, and if we all have parents that are still alive, we all know that seniors get just railroaded these days when it comes to finances and people taking advantage of them. I get all my mom's mail now, and I literally get probably that much mail. I probably get that much mail a week, but I get at least a short stack every day. It's just stuff that, here, donation there, give us your money.
Mm-hmm.
So what are the fees? I know I did a reverse mortgage for my mom, like probably 8 to 10 years ago, and it was literally $20,000.
That's about right, yeah.
And
They're not
so I
cheap.
had to do it, and maintain the house to get it sold.
Sure.
So it was good, but the fees are generally, they're still the same.
Yeah, they're not cheap,
Okay.
and part of that is the mortgage insurance premium that you have to pay. That's part of the fact that they're ensuring that the house, the numbers, it's kind of sad, but the reality of it is that the numbers are run based on the fact that we're all going to die someday. So they bank on the fact that the person that owns the home is not going to outlive the loan.
That's more advantageous to you guys if they
Well,
died
yeah,
and
they
lived to be
wouldn't have
104.
Yeah, they wouldn't have the loan product, but the reality of it is if you live beyond the equity of your home,
Then that's it, you're free to stay.
Yeah,
Mhm.
you're good.
It's a gamble.
But if
It
you
is.
but if you die before the equity is used up,
Yeah,
then
you
you're
can sell the house.
heirs.
Yep.
Okay.
Family.
Yeah, I had actually dealt with a customer of mine just recently that his father had a reverse mortgage, and he and his brother came to me to help them refinance out of the reverse mortgage for their dad. He had a Camino Island house that he had a reverse mortgage on. He lived up there, and they were angry at first, like, I can't believe my dad got a reverse mortgage. Blah, blah, blah. He used to be a president of a bank and everything. He's a smart guy, and I'm like, do you ever think about the fact that your dad didn't have a house payment for the last, 10 years or whatever, how long he had that reverse mortgage? But yeah, you have, once they end the reverse mortgage, and actually this is good information for when you do come across the client that you're selling their house or come across their children that you're helping them sell their parents' house that was under a reverse mortgage. They have 90 days to tell the reverse mortgage company their plan, either to sell, refinance out of it, or whatever, however they're going to change or get out of the reverse mortgage, or end that loan basically on that house. And they're pretty strict about it, but they have to be, because I'm sure lots of people's parents pass